some default comes, default will lead to, of course, a liquidity problem also. Bank can give a loan of 25 lakhs. Here the bank, you can utilize it. If the loan is given at a lower rate, if there is a premature withdrawal of deposit or premature closure of loan also. Premature closure of loan means for the credit risk there is a default risk is there. So many other risks also we have discussed in that kind of transaction. Okay, we have been discussing about the various types of basics risk which transactions actually takes to the bank's books of accounts in the normal banking transactions. In the credit transactions mainly. So the various types of risk, starting from credit risk, default risk, time risk, funding risk, embedded option, reinvestment, everything. Apart from that, other risks are also there. Let us see one by one in detail. So gap or mismatch risk will also be there when long-term loans assets are funded by short-term deposits. That is what we have discussed in the previous case study. Or with different interest rates, 6.5, 5.5 renewal, 6.5 is invested in 12-point interest rate loan. Then again we were forced to renew it at 6.75. So there is a gap of 0.25 like that. Assets of bank should match with the liabilities. Of course, that is what the asset liability mismatch. There comes the mismatch or negative gap also. So that also has to be addressed. There will be some risk in that mismatch also. Whenever there is a gap or mismatch, there will be a risk. Default of repayment leads to default risk. What do you normally use the bank, the EMI? When you collect EMI, we will reinvest it in some other loans and advance and generate income. So EMI, here the bank can give a loan of 25 lakhs you are getting as EMI. This month 25 lakhs has come as your inflow. That the bank can give a loan of 25 lakhs. Here the bank, you can utilize it. If the loan is given at a lower rate, you see here, lower rate than that of the original loan. Original loan, if it is given as 12%, that is the original loan. Original loan given for a 12%. Then you are using a reinvestment loan. Using this reinvestment EMI, you are giving a new loan. It should be minimum 12%. That is the original loan interest rate. It should not fall below that of 12%. That is what reinvestment risk is at floating rate. And deposit interest is at fixed rate. That is what we discussed. Fixed rate deposit, floating rate interest. If it comes down adversely, it will affect our net interest income. If the rate goes up, well and good, there is no problem. But sometimes it may come down also. At that point of time, the net interest income, the difference between the interest expenses and interest income, the difference NII will come down. There will be a risk, interest rate risk or basis risk. So floating rate and deposit interest is fixed rate. When MCLR goes down, lending rates get reduced. Lending rates gets reduced means leading to a risk. That means NII will come down, called basis risk. Here, reduction in floating rate leads to reduction in NII, net interest income, NII. Net interest income, NII, that is what we, the formula is equal to interest income minus interest expenses. This is cost of deposit. This is income from loans and advances. Interest from loans and advances. So, the difference between interest income and interest expenses is net interest income. So, it will affect the net interest income also. That will be a basis due to basis risk. That basis risk, whenever basis risk is mentioned, there is you look for a clause, that is MCLR changes, floating and fixed rate between the assets and liabilities. So that will lead to a basis risk. That is also an interest rate risk. Basis risk is an interest rate risk. Let us see another scenario where a loan is getting repaid by EMI. So EMI, here comes the EMI clause. Loan is getting repaid by EMI of 25 lakhs, for example. This is bank's inflow. EMI is coming as inflow. That is liquidity. Inflow is our liquidity. That means the ready cash available for you for meeting any immediate repayment obligation or whatever. If you are investing, if you want to invest in some loans, it is also an inflow which can be utilized for further investment. What do you normally use the bank, the EMI? When you collect EMI, we will reinvest it in some other loans and advance and generate income. So EMI, here the bank can give a loan of 25 lakhs you are getting as EMI. This month 25 lakhs has come as your inflow. That the bank can give a loan of 25 lakhs. Here the bank, you can utilize it. If the loan is given at a lower rate, you see here, lower rate than that of the original loan. Original loan, if it is given as 12%, that is the original loan given for a 12%. Then you are using a reinvestment loan. Using this reinvestment EMI, you are giving a new loan. It should be minimum 12%. That is the original loan interest rate. It should not fall below that of 12%. That is what reinvestment risk says. Here bank can give a loan of rupees 25. If the loan is given at a lower rate than that of the original loan, this is important, than that of the original loan, banks attract reinvestment risk. In other words, when bank reinvest EMI, it should be more than the interest rate of the original loan. We should always see that we should finance the reinvested amount at a rate higher than that of 12%. It is 12.5 or 13 like that. So that is called a reinvestment risk. Reinvestment risk is more important because you will attract reinvestment risk if you finance the reinvested amount loan at a lower rate of interest than that of the original loan. Okay, EMI, it should be more than that of the interest of the original loan. Whenever there is a premature closure happens, either on loan or assets or on deposit liabilities, there will be a risk called embedded option. Premature loans mean it will affect your liquidity. You have planned something for 3 years. Before that, at the end of 1 year, the entire projections will be disturbed. If there is a premature withdrawal of deposit or premature closure of loan also. Premature closure of loan means for the 5 years you have projected income at 12%. You have projected reinvestment of this EMI at 12%, higher than 12% rate every month or every quarter or every year like that. So all those projections will be disturbed. So in that case, there will be a risk called embedded option risk. So embedded option is always come into picture when some premature closure happens. So various types of risk. Other than this normal, this 7 or 9 risk which we have discussed, there are so many risks are there. So all these risks, why do you address, assess, analyze, identify, measure risk? Because we need to measure and we have to calculate capital and keep capital as buffer to absorb any losses from these risky transactions. So that is what is mentioned under Basel guidelines. Basel 1 says that you have to keep a minimum capital, that is MCR requirement. That is what we discussed in some classes. MCR, minimum capital requirement. So it is coming under the pillar 1. There are 3 pillars which we will discuss in regulatory session. So here you see that pillar 1, Basel risk. There are so many risks are there. So Basel 1 risk says about the capital requirement. Why capital is needed? Because we need to address the risky situation, risky scenario, unfortunate uncertainty. So we need to account capital. We need to keep apart capital to address or absorb any losses happening. So those kind of risk we need to address. We need to find out what are all the risks we have to identify and measure. What are all the type of capital you have to measure against what kind of risk. There are 3 major risks we have to identify and address. And you need to measure these 3 risks using the various tools given by the Basel guidelines and your regulator. Accordingly, you have to calculate the risk, quantify the risk and keep capital as a buffer to address any losses. So that capital, what are all the risks you have to identify and address? The first one is, Basel says that it is credit risk. Credit risk is the first one. You have to identify credit risk, like the transactions earlier we were discussing about 1 crore deposit and 1 crore loan, 3-year deposit and 5-year loan, like that. So there we identified the risk that it is a credit. There is a credit risk there. There is a default risk is there. So many other risks also we have discussed in that kind of transaction. Like that, the pillar 1, Basel says that first risk you have to address, identify is credit risk. It is defined as the possibility of losses. That is the uncertainty associated with default or by diminution of the credit quality of borrowers or counterparties arising from outright default due to inability or unwillingness of a borrower. This is the definition of credit risk as per the Basel guidelines. They say that mainly the clause is default. Due to default it happens. The credit quality of the borrowers deteriorates. The credit which you have already taken into your books have deteriorated from the standard assets. It has slipped to special mention account, that is the SMA accounts. Then it has fallen to NPA category, substandard, doubtful assets, like that. So the quality of asset has deteriorated. There is a diminution of the security values, a quality of security, the quality of borrowers or counterparties arising from outright default due to inability or unwillingness of a borrower or counterparty to meet commitments. That is the unwillingness of the borrower, that is the chance of committing default has to be identified, which is a credit risk in relation to lending, trading, settlement and other financial transaction, or reduction in portfolio value arising from actual or perceived deterioration in credit quality. All kind of things leading to deterioration in credit quality of borrowers or counterparties. So credit risk emanates from the bank's dealings with an individual, non-corporate, corporate, bank, financial institution or sovereign government. So all these kind of transactions may lead to credit risk, which you have to identify first. So in the normal transaction, what are all the possibilities of this happening? This uncertainties happening. Quality may deteriorate, chances of commitment of default, or what are all the types of borrowers, individual, non-corporate, corporate, banks, everything. So whatever the clients involved, whoever is the client, if there is a credit transaction, you have to identify the risk, which is a credit risk, which is happening in your credit portfolio. That is in your banking book of accounts, which is with regard to your loans and advances and deposits. So what are all the products you are dealing with? What are all the transactions you are entering into? All these transactions, whether it is open to such kind of risk. That is the first one you have to assess is credit risk. That is what the pillar 1 Basel says, that it should be the first risk which has to be taken care of for the purpose of maintaining capital. If a risk is addressed or identified as credit risk, against which you have to keep capital. So how to keep capital? There are so many methods. The second one is the market risk. So credit risk you identify, you measure, you keep capital. Then you go for the market risk. Credit risk, where it happens in your banking book of accounts, that is with regard to deposit and advances. Then you go for some investment. The surplus money you are going to the market and investing in the market securities like shares, bonds, etc. There comes the market risk. The second one is market risk. That is most important. The first one, to maintain capital, the first one is credit risk. The second one is market risk. Market risk. So is defined as the risk that the value of on or off balance sheet position, on balance sheet or off balance sheet position. Off balance sheet position like BGLCs may anytime become on balance sheet also. So those positions will be adversely affected by movement in equity and interest rate, share value, interest rate prices, movement of interest adversely in the market. Those kind of adverse scenario will lead to market risk. Currency exchange rates, wide fluctuation in currency exchange. As you know that pound sterling today will be 100, yesterday it was 90, tomorrow it may be 102, like that the dollar, like that the Jewish mark, other currencies, foreign currencies, fluctuations. And also the interest rate. Today the market if the market rate is 5.5, tomorrow it will become 5.75. Yesterday it was 4.75. Like that, the various wide fluctuation, volatility in the rate of interest. Interest rate risk is there in the market scenario. When it goes up or down, how it will affect the existing bond price holders, the bond value will adversely affect. Those kind of things will be open, called market risk. And interest rate, currency exchange rates, and commodity prices. Market risk is thus the possibility of loss to the bank caused by changes in the market variables. What are all the market variables? Market variables, mainly interest rate, demand supply position, other adverse conditions, adverse movement in rate of interest in the market. All those things may lead to market risk. So market risk comprises general market risk and specific risk. General market risk is due to the volatility of the whole market scenario, the entire demand purchase, the demand supply position, the market conditions, the adverse movement in rate of interest, etc., for the whole market. General market risk. So it will lead to a general market risk. Then specific market risk, that is issuer based market risk. For a particular security or particular issuer may go bad on a point of time. At that time, it will lead to a risk called a specific risk. It will be applicable to that specific particular security or that specific issuer. So specific risk is also there, market risk is also there. That is why whenever we will discuss this one, we will come to know at the time of measurement of market risk, we will add these two things together. We will calculate general market risk and also specific market risk. Then we will combine together, we will keep capital corresponding to that market risk towards maintenance of capital under Basel guidelines. Pillar 1 says that you need to calculate credit risk as well as market risk. So, what is credit risk? What is market risk? Credit risk happens to the banking book of accounts for the transactions in your deposits and advance portfolio. Market risk happens in your trading book of accounts, your investment portfolio, your trading activities. So, these two things you have to calculate and keep capital for these two. Apart from this, there is another risk. What is that risk? There is another risk for keeping capital, operational risk. So, is defined as, what is operational risk? As we discussed in the previous session also, operational risk is nothing but the failure of systems and procedure by internal processes or externally. Factors due to internal failure or external factors in the external happenings also. These two things may lead to operational risk, which is nothing but the failure of the systems and procedure. It is defined as by the Basel Committee. What the Basel Committee says? Basel Committee says operational risk as the risk of loss resulting from inadequate or failed internal process. When your internal processes fail, there will be a risk called operational risk. When the people and system from external events also, failure of people and system are from external sources. External sources conditions also may lead to failure of your operation. So that these three risks, when you identify, you need to keep capital towards all these three risks, which is required under Basel 1, Pillar 1. Pillar 1, Basel guidelines. A, B, C. These three you have to remember. So, capital is required. This is more important. Capital is required to, from which risk? Credit risk is required. Plus, operational risk also capital is required. Plus, market risk also capital is required. These three risks, you have to maintain capital. How to find out credit risk? We have some tools, systems, procedures. Operational risk, we have some tools, procedures. Market risk also, we have some tools, procedures and system. So you calculate credit risk, you calculate operational risk, you calculate market risk, you keep capital against that. So this is the regulatory capital. Regulatory capital. Regulatory. So regulatory capital, how to calculate? Capital is equal to, how to calculate capital? The formula, you remember the first one? Exposure into risk weight into CAR, capital adequacy ratio, CAR. This risk weight, exposure into risk weight is called a risk weighted asset. Remember this one. These are all the basic mantras of risk management. Risk weighted asset. What are all the risk weighted asset? That is what we discussed now. Risk weighted asset is equal to credit risk plus market risk plus operational risk. You need to consider all these three things together, then you find out the total risk weighted asset for this one. So capital is equal to these three things. Capital, this exposure into risk weight is called a risk weighted asset. So therefore, our formula, what will be our formula? Our formula will be capital is equal to risk weighted asset, RWA, risk weighted asset. That is the exposure into risk weighted asset into CAR. Then what is risk weighted asset? Risk weighted asset is operational risk weighted asset, market risk weighted asset, credit risk weighted asset. So these three things you have to add together. That is what Basel says. Basel 1 says that credit risk, market risk and operational risk. So that is what is operational. All these three things you have to identify and calculate. Then you keep calculate. So capital is required for credit risk, market risk, operational risk. So pillar 2, Basel, other material risk. Other than these three major risks, pillar 2 is talking about, so first one is MCR, capital requirement. The pillar 2 says about the supervisory process. Under the supervisory process, what the Basel pillar 2 says that you have to supervise the guidelines which under pillar 1, whether the capital is adequately maintained or not. That is what it is described under pillar 2. So basically pillar 2 says credit concentration risk, so many risks, material risk, the other material risk, these are called other material supplementary risk. So along with this credit risk, market risk, operational risk, you need to consider the other major risks also, which are majorly credit concentration. Concentration doesn't require any, because the name itself it is implied there. The concentration risk arising from an uneven distribution of counterparties or from a concentration in industries which may generate losses large enough to jeopardize bank's position. Because in nutshell, you are not supposed to put every egg in a single basket. That's all. So you should not concentrate on single product. You have to go for diversification. So counter risk, country risk is risk arising out of political, social, economic factors which can impinge on a country's capacity, ability and willingness to honor its international offshore obligation. So country risk, when other country involved is not able to maintain if two parties are involved, the one counterparty in other country is not able to meet the payment obligations on time because of the ban or something, sovereign restrictions like that, there will be a risk called country risk, which is arising out of political, social and economic factors. Then comes the liquidity risk, which you know that there is a inability to meet immediate payment requirement. Liquidity represents the ability to maintain statutory prescriptions, meet contractual and maturing cash outflows and profitability, deploy surplus cash. Liquidity. Then compliance risk. You are not able to comply with the statutory guidelines. Bank says that, the regulator says that 9% should be the minimum capital. If you are not Complying with the instructions, regulations, there is a risk called compliance. It will lead to penalty. Compliance is defined as the risk of legal regulatory sanctions, material financial losses, or loss of reputation a bank may suffer because of its failure to comply with laws. You are not complying with the laws, regulations, rules, related self-regulatory organizational standard and code of conduct applicable to its banking activities. So statutory guidelines are not complied with. Interest rate risk. Interest rate risk refers to fluctuations bank's net interest income due to change in the interest variables. Major risk, then cyber risk that represent the possibility of circumventing, exploiting technologies for process. The name itself says talent risk, because the inability of the man force, because they are not giving adequate training, that they are not giving instructions properly. So if they fail of talent, human resources risk is the risk arising from following factors: talents, employee attrition, employee absenteeism, training infrastructure risk, employee productivity, employee motivation, etc. Talent risk. Reputation risk, of course. Reputation risk is the risk of damage to the reputation, as we have been discussing in the first class about the HQLA. That is high quality liquidity asset was showing us in the first item in the balance sheet. It shows that the liquidity is strong. So if the liquidity is not strong and in the next balance sheet they say that it has come down, it will affect the reputation. If you go to the bank, ask for a premature deposit, if the bank says, no, we don't have a fund today, we have to arrange, you come next week, like that, if it is told like that, it will affect the reputation. So reputation risk is the risk of damage to the reputation. Name or brand of a bank arising directly from the organization or indirectly from the action of the employees and associated parties, such as joint venture, subsidiary, resulting in impact of earning. Contagion risk, contagion, like a contagious disease, So action of one unit, one subsidiary unit, one associate will affect the primary unit. So that will be a contagious risk is there. Contagion risk is defined as the current and prospective risk to earning or capital by which liabilities, losses or events affecting a particular legal entity, which is the primary entity, may affect another legal entity within the group. So one primary entity, because of the loss booked by the one industry, primary industry will go and spread to other industry within the group, resulting in loss or risk of loss. That is called a contagion risk. The name itself actually it describes. Pension obligation. When the pension obligation fund is not there sufficient, we have a reserve. So many types of reserve. When you discuss reserve, you will come to know. Specific reserve, general reserve, etc. So pension obligation risk, if there is no specific reserve for this thing, you will fail. Pension obligation risk is the risk to the bank employees' pension scheme and financial condition arising from underfunded demand benefit of pension plan. Residual risk, risk arising due to inappropriate valuation. Your value is described, value of asset which you are assessing at this much amount. After that, it will deteriorate, the quality will deteriorate, the residual value will come down, it will affect your exposure or security position. Finally, we end up in a higher percentage of unsecured portion of a particular exposure. So, there will be a residual risk due to inappropriate valuation, deterioration in quality, or unclear title to the properties accepted as collateral by the bank. These are the risks arising from use of credit risk management techniques and are not fully covered under Pillar 1 credit risk capital. So, model risk is defined as the risk of error in estimated risk measures due to inadequate or deficiencies in the models. If there is a failure at the time of evolving strategies and putting up a new model, if there is not properly addressed, the pros and cons are not properly addressed, means there will be a risk. Which model risk? It relates to the risk of inaccurate assessment of underlying risk arising from inappropriate models. Then strategic risk is the risk of current or prospective impact on the bank's earnings, capital, standing arising from the strategic decision. When the strategic decision fails, there will be a risk called a strategic risk. It comes from the top management level. They will address those kind of issues. Other intrinsic risk of business impacting the ability of the bank. Finally, the settlement risk, the risk that a transaction is not settled as expected through a settlement system. This we were discussing under Herstad risk in the first session. So Herstad risk happened because of the failure in the settlement. So this result in settlement risk. It comprises credit risk elements, treasury transactions, etc.